that we have faced from our experience of handling clients and what you need to do regarding these issues. So, uh, listen carefully. We have the co-speaker with me is Akshay, the other partner for indirect taxes with us, who will be taking the presentation. And I would also request you that whatever questions you have, please put that in the chat box. And Akshay and myself will take those questions at the end of the presentation. Okay. So without much ado, I would like to invite Akshay to take on and start his presentation. Yeah, over
Thank
to
you,
you,
Subrata.
Akshay.
Thank you, Subrata. Welcome to all participants. I'll just share my screen. I hope my screen is visible, Subrata.
Yes, the screen is visible. Please go ahead.
Thank you. So basically, we are here to discuss, deliberate on the issues that we face in GST compliances. Now, we have tried to compile these issues from our practical experience over the years. We have also tried to provide a few action points or a few solutions to those issues, how we can tackle those issues, how we can go about it. And that's the whole intention of today's webinar. So just to introduce, just to talk a bit about the GST itself, though everyone is aware, I'll take you through a few things. The vision, which was published through various papers by the government, was one nation, one tax, a seamless flow of input tax credit, and ease of doing business. Now, in my personal opinion, I think all these visions or all these intentions that the government had have been to a great extent been achieved, but there are a few issues here and there which still need to be tightened. But all in all, it's going quite well. The vision is towards achieving what it's meant for. Now, the original compliance scheme of GST uh, had GSTR 1, 2, 3 in mind. One was outward supply details, two was inward supply details, and three would then auto populate or consolidate the 1 and 2 and work out the GST liability in form of GSTR 3, which would then be paid through GSTR 3. Then there was GSTR 9, which was a consolidation of all the monthly returns in an annual format, and 9C, which was a reconciliation statement with the annual financial statements, which would uh, be filed, which would be reconciled with the GSTR 9. In the present compliance scheme, we have the GSTR 1 as was contemplated in the beginning, so which the outward supplies are filed through the GSTR 1. Recently, the GSTR 1A has been introduced for making any amendments that are required in the GSTR 1. Then we have the GSTR 2B, which is the auto-drafted static ITC statement based on the GSTR 1 filed by the suppliers. Now, the government has also introduced the IMS, which we'll talk about in the further slides, which I think is kind of a backdoor entry for the GSTR 2, where you are actually then selecting or finalizing your GSTR 2 entries, which are the ITC entries, which then get auto-populated into the GSTR 2B. Then we have the GSTR 3B, which is nothing different than GSTR 3, which was contemplated earlier, which is the self-assessed summary and through which you pay the tax. And 9 and 9C stay the same, except for the certification by CA has now been replaced by self-certification. Then there are GST notices and investigations. And this is exactly what we are trying to address today, that how we can make our compliances good enough to avoid to the extent possible, or at least to reduce the impact of these GST notices and investigations. So in GST notices, we have scrutiny notices, we have show cause notices, AS and T10. We have all definitely gone through one or the other of these notices. Then there are departmental audits where the department officers thoroughly go through the books of accounts, the compliances that have been done. And there are investigations which are into specific matters. What we have done here is we have tried to identify 10 areas, and on each area we have taken a few issues that we'll discuss in the future slides. So we're talking about books and records. We'll talk about ITC eligibility, GSTR 2B, RCM, place of supply, ITC reversals, IMS, ISD, which are the new entrants into the GST system, e-invoicing and e-way bills, and something that irritates everyone, which is the technical glitches and portal instability that we face from time to time. So to look at the first thing, the books and records. Now, these are mainly applicable for all the GST registered people, but a little more concentration needs for the people who have multi-location operations, who have multiple GSTINs in various states. Now, the GST law contemplates location-wise maintenance of these books and records. Section 35 of the GST Act, read with Rule 56, specifically mentions that each location or each GSTIN that a business or a taxpayer has needs to comply with these requirements of the maintenance of books. So the thing to be done would be to configure the accounting system where the records can be maintained at a GSTN level. This can be done through cost centers or any other way that the system offers to maintain books, which can separately identify entries for the various GSTINs. A thing that mostly MSMEs fail to maintain are stock records. Now, stock records have also been mandated by the GST system, by the GST law. These stock records basically need to have details of goods received, goods consumed, dispatched, and closing stock, and these again need to be GSTN wise. MSMEs, from our experience, we have seen normally don't maintain these records. So this is something that they need to take note of and start maintaining the records in the way the system contemplates. One more important issue in this is that we always see that the books are not updated in real time, which causes errors in returns and which causes a loss of credit in case of ITC. So the best thing to do is to keep all accounts real time and finalize the accounts well before the due dates of the returns and strictly avoid any backdated entries. What can happen is if we pass, for example, an ITCA entry backdated, which falls in the earlier month, and when we are filing the return for the next month, that entry gets ignored. So you can have loss of credit in that case. Now, having said all this, we have not seen officers specifically penalizing businesses for maintenance of books of accounts, but you never know. If the officer doesn't find anything else, he'll definitely come to this point and start penalizing on maintenance of books of accounts as well. In terms of ITC eligibility, uh, we all know Section 16 specifies the provisions for the eligibility of ITC, and Section 17 provides the blocked credits. Section 16.4, we are all aware, is the time barring section where we have to claim all ITC before the November of the next year. Section 16 also has two major provisions which relate to the suppliers, where here the taxpayer himself or we don't have any control. The control is with the supplier, where the supplier needs to file his return in GSTR1 and then that return needs to appear in our GSTR2B, and the supplier also needs to pay tax. Now, these two things is something that is not in our control. It is something that is expected out of the supplier, but still we can end up getting penalized for this. To ensure that the supplier is doing his compliance properly, it is very, very important to keep following up with the supplier for ensuring that he does his compliance on time so that we don't lose out on any ITC. Probably we have seen larger companies also enabling measures like the GST on invoices is paid only after the invoice appears in the GSTR2B. So these kind of measures to ensure compliance can probably be looked at if there are any suppliers who are not very regular in filing their returns. One important factor that most of the businesses miss is about Section 17 block credits. Most of the people normally don't claim the block credits, but what is missed is the entries that are passed in the books of accounts normally are passed by grossing up the GST value. For example, if a vehicle is purchased, which is covered under Section 17.5, if a vehicle is purchased, the GST on that vehicle is not available. If it is a 13-seater or less, the GST on that is not available as ITC. Most of the businesses, what they will do is they'll gross up the ITC along with the cost of the vehicle and book the entire thing, capitalize the entire thing. That GST never comes in the GST return in the GST 3B, and it is not reversed, obviously. So legally speaking, there is nothing wrong that we are doing in this. What we have observed in scrutiny assessments or in investigations is that GSTR 2B shows that specific ITC for vehicle appearing in the GSTR 2B. Now, for that same month, when the officer looks at the GSTR 3B, he doesn't see any reversal made. The officer immediately questions that there is a vehicle that you have purchased, there is a 17.5 block credit, and you have not reversed the block credit. These can be explained, but then you're again opening the door to litigation. So it's the best thing to do is for even for blocked credits or for ineligible ITC, claim the ITC and again reverse it in the GSTR 3B in table 4B1 of the GSTR 3B. There is a specific provision in GSTR 3B table 4B1 where reversals on account of rule 42, rule 43 and 17.5 are to be mentioned. So that's where you can reverse the ITC so that it becomes very clear from the GSTR 3B itself that the ITC has been reversed, whichever block ITC is there has been reversed. So the officer is convinced. It is easier to convince the officer to that extent. Now, GSTR 2B has been, since it was launched in 2022, it has been the single most litigative area. And as such, then it's the most care needs to be put into this area. So the major issues that we find are suppliers obviously don't file their GSTR once, so the auto population in the GSTR 2B doesn't happen. Supplier uploads invoice in a different date, in a different month as compared to the invoice date. For example, the invoice is dated January, the supplier would upload it in March. So there is a timing difference. In this case, it is extremely important to track and claim the invoice in the GSTR 3B as ITC only when the invoice appears in GSTR 2B. So track needs to be maintained because we'll have booked in the invoice in our books in the month of January, but it is not appearing in, if it is not appearing in 2B, you can't claim it in January. Again, it is not appearing in February, you can't claim in February. Once it appears in March, then you can claim it in in your GSTR 3B. So you need to track that invoice closely. There is also an issue with import ITC where there is a lot of times the bill of entry and the GST that is paid, IGST that is paid through the bill of entry doesn't auto-populate in the GSTR 2B. In such cases, it is advisable to download the bill of entry wise import data from the IceGate, match it, and wherever there are differences, if the documentary proof of the bill of entry is available with us, we can claim that differential amount in the 3B. And when the notice comes, it can be explained in that way, along with the documentary evidences. Credit notes, when the supplier raises credit notes, it automatically reduces our ITC in the 2B. Now, for credit notes, it is very important to give the appropriate treatment in the IMS. So if a credit note is raised against a specific invoice, if that invoice in the IMS has been accepted by us, then probably if the credit note is acceptable, we can accept the credit note. But if the original invoice itself has been rejected, then the acceptance of a credit note could mean double loss of ITC because we have already not accepted the invoice, so we have not claimed ITC, and now we are trying to reverse the ITC by accepting the credit note. So in that case, you'll have to refer to the treatment that has been given in IMS to the original invoice. If that has been rejected, then please also reject the credit note. This is a very important point where year-end unreconciled invoices can appear when we do the overall yearly reconciliation of ITC as claimed in the GSTR 3B or as appears in the books with the GSTR 2B for the entire period. Now, there could be a lot of unreconciled invoices in such a reconciliation where the invoice is available with us, where we have actually received the goods or services, and we have paid the supplier within 6 months. So, which means the ITC is very much a genuine and legitimate ITC claim. But only because that particular invoice doesn't appear in the GSTR 2B, we are unable to claim that ITC. In such a case, the practical solution is to review these unreconciled invoices, evaluate the genuineness of such ITC claims, claim it in the return of October, latest up to the return of October, claim it in the return. And because it is not there in the 2B, reverse it in the same return. Now, this what this helps in is there is a limit for the first claim of ITC in the GST law, and that limit is till the November of the next year. But there is no limit on reclaim of ITC. In fact, there is specifically provided in Rule 42 that any reclaim can be made even after the year ends anytime in the future if the original claim has been made in time. So by claiming this ITC and then reversing it, when the supplier finally uh, files his return and that invoice finally appears in the GSTR 2B, then you become eligible for the claim, and then you can actually reclaim the invoice in spite of it being beyond the 16/4 timeline. The next area that we would like to discuss is the RCM, the reverse charge mechanism. Now, in case of GTA services is the most common area in which we have to pay RCM. Now, GTA under notification 11/2017 has three options. First option is that they opt for RCM, whereby the receiver of the services pays tax at 5%. The second option is they opt for forward charge mechanism. Now, under forward charge mechanism or FCM, again there are two options. The first option is they pay tax at 5%. They charge tax of 5% to the receiver. The receiver can claim the ITC, but the GTA himself cannot claim the ITC. Another option is they can charge the tax at 18% and then claim the ITC. Now, when the GTA is charging the tax at 5%, there can be a confusion. We have seen this confusion arising in a lot of taxpayers, where 5% is charged, they get confused whether this 5% is under RCM or FCM. So it's always better to get written confirmations from the GTA of what their exact option is that they have selected at the beginning of the year, so that we don't end up paying RCM unnecessarily, where the transporter has also paid the tax under forward charge mechanism. Self-invoicing is again something that is missed by most of the taxpayers. We need to raise self-invoices in case of RCM invoices, in case of unregistered dealers, where the dealer or where the supplier is a registered supplier who has filed his GSTR1 and shown that this is the RCM liability that the receiver has to pay. In such cases, self-invoicing is not expected, but where the supplier is an unregistered dealer, in such cases, self-invoicing is absolutely essential. And lack of such self-invoicing can lead to a possible denial of ITC at any scrutiny or assessment stage. So it is always advisable to have a serially numbered self-invoices for every RCM transaction, best to be raised on the date of payment itself. Now, ITC on RCM is available only when the tax is actually paid in cash. Now, when we file the regular GSTR 3B returns, in the 3B returns where you have shown liability under RCM, automatically when you are paying the tax under the 3B, the system doesn't allow you to pay it through the credit ledger. You have to compulsorily pay it through cash ledger. But when such liability arises as part of a reconciliation at the end of the year, or while filing the annual return in November or December, in such cases, the liability needs to be paid through a DRC-03 challan. Now, the DRC-03 challan doesn't have any such controlling mechanism, where it doesn't recognize what kind of liability is being paid through that challan. So if you are paying RCM liability, the DRC-03 will still allow you to pay it through the credit ledger. But because the law contemplates payment of RCM only through the cash ledger, the credit can be definitely denied on this if it is paid through the credit ledger. So you have to ensure that all RCM liabilities, including such DRC-03s, happen only through the cash ledger and not through the credit ledger. In case of place of supply, a lot of times place of supply provisions are misunderstood by taxpayers, where in cases where an IGST should be charged, a CGST, SGST is charged, and such cases can come up even while filing the GSTR 1 or 3B returns. Now, when such a case is identified, the best thing to do where the wrong tax has been charged in the invoice, it's best to pay the tax, pay the correct tax again. So if in a particular invoice where IGST should have been charged, CGST, SGST has been charged by mistake, you'll have to pay the CGST, SGST because you've charged it to the customer. You'll have to pay the IGST because it is the right tax to pay. In such a case, you can file a refund under Section 77 for the wrong tax that has been charged. So CGST, SGST, which has been charged and paid, but which is a wrong in terms of the place of supply provisions, can be claimed as a refund by filing a refund under Section 77. Again, this refund has strict timelines. From the date of transaction, this needs to happen within 2 years from the date of transaction. So proper control needs to be maintained in this case. Now, in case of immovable property, any services which are related to immovable properties, the place of supply of such services are always the location of that immovable property, and it doesn't matter where the service provider is located or where the service receiver is located. This mainly comes up in case of ITC, where say some personnel from the taxpayers company have traveled to a different state, they have stayed there. The hotel in that particular state will charge a CGST, SGST, even though you have given, say, for example, the person has traveled from Maharashtra to, say, a Karnataka to a Bangalore. The hotel in Bangalore will issue a CGST, SGST invoice, even mentioning the Maharashtra GSTIN of the customer. Now, that particular GST is going to appear in the GSTR 2B as CGST, SGST. Normally, what happens with the taxpayers is this CGST, SGST is claimed as such in the GSTR 3B. But because the place of supply is a different state and you cannot claim the ITC of a particular state unless you are registered in that state, that ITC becomes a ineligible ITC, which then comes up in scrutiny assessments and all. And then at that time, it gets rejected along with penalties and interests. So it is very important to, in that case, in the system itself, map the property location and not the party's registered office addresses, where the such office addresses fall outside the system or where the property location falls outside the state, and such place of supply ITC cannot be claimed by the taxpayer. Now, place of supply is also very important in case of intermediary services. Till the budget of 2026, the intermediary services had a special provision in case of place of supply, where otherwise for all other services, the place of the service recipient was considered to be the place of supply. In case of intermediary services, place of the supplier was considered to be the place of supply. So where the supplier was located, intermediary was located within India, and the service was provided to a customer outside India. In such a case, because the place of supply was within India, such services were considered to be domestic services and did not qualify as export services. But the 2026 budget has made this very welcome change. They have excluded that specific clause in section 13, subsection 8. They have excluded the clause B, which specified that in case of intermediary services, the place of supply would be determined by the location of the supplier. So in effect, now intermediary services also qualify for export where the service supplier is within India and the service recipient is outside India. So in case you're providing intermediary services to customers outside India, it is very important that you re-examine the invoicing, because earlier you would be charging tax on it and paying tax on it. Now, because it is an export, it qualifies as an export. You can file an LUT, which is a letter of undertaking, and without charging any tax, with zero tax, you can invoice to the customer. Plus, because this is a zero rated supply, zero rated service supply, you can also claim refund on any ITC that is directly relatable to such a supply. So this needs to be re-examined, re-evaluated, and any changes that need to be made in the billing system need to be immediately accounted for. ITC reversals are prescribed under sections 16, section 17, rules 42, rules 43. There are other rules also. These are the most common. In section 16, basically, where like we discussed earlier, where an invoice doesn't appear in GSTR 2B, reversal is required. In section 17, where there are block credits, reversals are required. In section 16, again, there is a time limit of 180 days, which has been provided and which is also covered under Rule 37, where if the supplier is not paid within 180 days, the ITC needs to be reversed. Rule 42, 43 also talk about in cases where there are exempt supplies being made along with taxable supplies by the taxpayer, or non-GST supplies being made by the taxpayer, then in such case, there is a proportionate ITC reversal that is required on the common ITC, which is governed by Rule 42 and Rule 43. Also, Section 17.5, as I mentioned, has specific reversals that are required in case of ineligible ITC. In case of works contract, the section specifically provides that any services or goods that are procured for construction of an immovable property are specifically not allowed, specifically ineligible. Now, there is again a carve out of that where such immovable property or immovable structure is meant for plant and machinery that is eligible, and it is where it is not a plant and machinery and it is just an immovable structure like a building or an office, then it is blocked or it is ineligible. So in such cases, it's very important to maintain the section 17.5 registered, and every purchase is tagged as eligible or blocked or partially blocked at invoice entry stage itself in the ERP. Because once the entry is made, it becomes very difficult to identify specific purchases or specific invoices against a specific project. So whether that invoice was actually eligible for claim under section 17.5 or it was blocked under 17.5 needs to be identified at the inception stage itself, at the invoice entry stage itself. Now, in case of section 30 or rule 37, it is very important to maintain an invoice level payment record, because when you're reversing the ITC on the end of 180 days, if after 180 days a payment is made against that particular invoice, you can reclaim the credit. Many times it happens, I've seen it in a lot of cases where such payments made after 180 days are not tracked. So the 180-day time limit is tracked. After the invoice, if the payment doesn't happen in 180 days, the ITC is reversed, and that's the end of it. If after 180 days a payment has been made, I've seen very less cases where actually there is a reclaim of ITC that happens. So it is very important to maintain an invoice level payment record of at least those invoices which have been reversed after 180 days, and the payment is closely tracked so that the reclaim can happen. In case of Rule 42, monthly reversals are done by the taxpayers, but what is missed is an annual true up. Now, an annual true up is a concept in Rule 42, which says that the monthly reversals need to happen on the basis of the proportion between the taxable supplies and the exempt supplies or the non-GST supplies for that particular month. But at the end of the year, a recalculation needs to be done for the entire period, and whatever is the difference. So if there is a short reversal of ITC, then the additional reversal needs to be made till September of the next year. If there is an excess reversal of ITC, which can also happen, where, for example, in a particular month, the exempt supplies were much more than the taxable supplies, and the ITC in that particular month itself was the highest. In such cases, what can happen is, because of the lopsided month, the ITC reversal can be much more than what it should be. So that annual reworking needs to happen, on the basis of which you may need to either pay for the short reversal, or you may be able to reclaim if there is any excess reversal. In case of Rule 43, uh, Rule 43 is basically applicable for, again, where there are taxable as well as non-taxable supplies, and these are for common capital goods which are used in both taxable as well as non-taxable supplies. Now, here the rule assumes a 5-year life for the asset, and the ITC is divided over 5 years. So for each month, 1/60th of the ITC is identified, and then on that amount, the proportion of non-taxable versus the total sales needs to be applied for the reversal. Now, this particular calculation needs to happen for every asset, because some asset might be purchased in the month of December, some might have been purchased in the month of March. So you can't directly take the entire block of assets and apply the formula for the reversal. The formula needs to be applied for each individual asset for each particular month. So it is best if we can maintain asset-wise capital goods register with details of the ITC availed on that particular asset, the exempted use percentage for that particular month, and the monthly reversal amount which is calculated. If such reversals under these various provisions are not made during filing of the GSTR 3B, they ultimately are discovered at the time of the annual return when the entire reconciliation of the accounts along with the GST returns is done. And if such reversal then ends up going to the annual return and the reversal is happening during the annual return, the interest, substantial interest of 18% becomes applicable on it. A good practice would be to ensure that a quarterly health check is done on the ITC and the reversals. The ITC, the reversals are proactively identified, and the correct reversals, if they have not been made in that quarter, in the immediate next month, such reversals are made, and the interest liability is restricted to the lowest possible level. Invoice management system is again a new concept that has been introduced by the department, which is not mandatory currently, but you never know, it can be made mandatory at any point in time. Now, there are a few issues that are that go with this IMS system. Firstly, the IMS has three options. So each invoice that comes in the IMS, which is basically filed by the supplier, each invoice you have the option to either accept the invoice or to reject the invoice or to keep it pending. Now, if a taxpayer does none of these, at the end of the time when you're about to file the GSTR 3B, the GSTR 2B gets auto generated through the IMS, and such invoices where no action has been taken default to deemed accepted. So these all invoices get accepted. Now, the problem with this deemed accepted is there could be some wrong invoices, some wrong ITC, which is not actually intended for the taxpayer, which have been populated under the IMS, which can get deemed accepted, and ultimately the ITC gets claimed on that. These issues can come up at the time of scrutiny's assessments. Again, there could also be an issue because when you are accepting or rejecting a particular invoice in IMS, the communication directly goes to the supplier that this particular invoice has been accepted. Now, consider a situation where a supplier has raised a wrong invoice. Say, for example, an additional zero has been put at the end of the amount, and a 1 lakh invoice becomes a 10 lakh invoice with the additional GST being charged on that. Now, where we have accepted such an invoice, the supplier can always say, if I am the supplier, I would always say that you have accepted the invoice in the GST system, now pay me the invoice. Though the invoice was actually for 1 lakh, you have accepted a 10 lakh invoice, please make the payment. So this ultimately leads into litigation and disputes. So it's always better to keep least possible reliance on the deemed accepted. It's better to set a cutoff date, preferably for 14th or 15th of the month, and to review all the IMS invoices and give the proper accept, reject, or pending remark on those particular invoices. In case there is any wrong acceptance of an invoice where the invoice actually doesn't belong to the taxpayer, but it is wrongly accepted, or a particular invoice is wrongly rejected, which is a genuine invoice, but which has been wrongly rejected. Once the GSTR to be locks, this becomes a permanent ITC loss. So whoever is involved in the in putting these accept, reject, or pending remarks on the IMS needs to be properly trained. It's best if the this particular thing is taken up by the accounts payable team because they are aware of what are the genuine purchases, what are not their purchases, and it would be best if they provide they put these accept, reject, pending remarks in the IMS. A rejection also doesn't auto trigger a supplier amendment. So if I am rejecting a particular invoice in the IMS, the supplier doesn't automatically gets his liability reduced. So this causes communication gaps and unresolved mismatches. So the rejection needs to be done only after confirming that it is genuinely incorrect. The particular invoice is genuinely incorrect. It's best to always communicate with the supplier follow up for a supplier amendment or for raising a credit note, and then take whatever action needs to be taken in the IMS. It is best to ideally integrate the IMS with the ERP itself so that automatic invoice mapping against the GST inputs in the system can happen, and it doesn't become an additional burden on the taxpayer or the team of the taxpayer to then do this entire activity at the end of the month. ISD is something that was introduced in the last year since April 2025 and was made mandatory. Now, what is an input service distributor? Input service distributor is mainly applicable for multi location entities which have GST registrations in various states. There are certain common services which are availed at the HO level. Now, for example, an audit fee is a service that is not especially only meant for the HO. Audit happens for the entire company, covering all the various states where the taxpayer has its presence. Such services are meant for all the company and all the states. Now, GST is a consumption-based tax. So, because it is a consumption-based tax, the service, the ITC or the GST needs to flow to the state in which that service or that goods are being consumed. ISD specifically addresses this. So any service which is a common service, which is related to all or many of the locations, the branch locations of the taxpayer in various states, such services need to be distributed. Such ITC on such services needs to be distributed to those various states. Now, this registration was made compulsory in April 2025. There would be a lot of taxpayers who have not yet done the registration. The most important thing is to register as ISD immediately if it is not done. ITC, if it is not registered, if the company is not registered under ISD, a very common stand that the department can take is any common service which has its impact and which is consumed all over the country or wherever the locations of the taxpayer are can become ineligible, and the department can disallow such services if they are not routed through the ISD. So it is extremely important to immediately get registered as ISD if already not done so, and switch billing of all common input services to such ISD. Now, what happens in case where you're late on such registration, you're doing the registration now, and the ISD was made mandatory since April 2025. So what happens for the entire period of financial year 25-26? What I would suggest is for the earlier period, you can identify what are the common services, what would be the ISD which is to be distributed to the various locations, and raise invoices on these various GSTINs for such distribution. So, though ISD has not been registered and the distribution has not happened through ISD, at least the taxpayer can claim that the proper distribution has happened, though not through ISD. So whatever penalty would apply will only apply for non-registration of ISD and not for non-distribution of the service ITC or common service ITC. Also, there is a lot of confusion between ISD and a cross charge. Honestly, if you ask me, I honestly think that cross charge was already present. So ISD became an additional kind of compliance that the taxpayer has to do. Probably this whole ISD service, common ITC distribution through ISD could have been integrated under cross charge, but we have to comply with whatever has been provided. So ISD and cross charge both have to be complied with. Now, the confusion basically comes because both contemplate charging to a location, to a different location from a location of the taxpayer, where both the locations are belong to the same PAN and belong to the same company. So cross charge basically still continues for specific costs, where, for example, Baker Tilly Pune, for example, has worked on any project which was for Baker Tilly Delhi. In such case, whatever cost has been incurred or whatever ITC has been generated by Pune, I'll charge that cost to Delhi, thereby transferring that ITC and that cost to the Delhi location. ISD is basically only for common input services. It is not a cross charge, and there is a very specific differentiation between the two. People who have already registered for ITC also miss out on one point, which is they distribute all the common ITC which is eligible. But the blocked credit under Section 17(5), that is not distributed by these taxpayers. Now, it is very important that the block credit is also distributed. Again, because GST is a consumption based law, what needs to flow is not ITC, what needs to flow is the GST to the specific state. So, if there is certain block credit which is in the HO, sitting in the HO, which actually belongs, which is a common credit which belongs to all the locations, that also needs to be distributed. And then the individual GSTN at their end will claim that credit and reverse it in their GSTR freebies. E-invoicing and e-way bills. This is again a very important area that has come up in the last few years. Rule 48 basically specifies that any non-generation of IRN is basically the invoice reference number which comes as uh, a QR code on the e-invoice. If such IRN is not generated, the invoice can be treated as invalid, which means two things. One is the taxpayer himself who is raising the invoice, who is a supplier, he can be penalized for not raising the correct invoice or not raising the invoice at all. And the customer can also be denied credit because the invoice that has been raised will not be considered a valid invoice unless there is an IRN present. So it is very important that the billing system of the taxpayer itself is integrated for this e-invoicing and IRN generation so that the process flows very smoothly. Another problem which comes with e-invoicing is such IRN cannot be cancelled beyond 24 hours. So once 24 hours expire after raising a particular e-invoice, such invoice cannot be cancelled. So what needs to be done beyond 24 hours? It's best to communicate with the customer that such an invoice needs to be cancelled, and accordingly you can either raise a credit note or make an amendment in that particular invoice. In case of e-way bills, a lot of times what happens is when the transport is in process, the e-way bill expires due to various reasons. It could be weather, it could be a breakdown of the vehicle, and the validity of the e-way bill expires. Now, in such a case, the consignment becomes liable for detention, seizure, penalty, etc. Now, what can be done in such situations? First, most important thing to be done is the transporter needs to be instructed that any delay is immediately communicated to the taxpayer. And the e-way bill system specifically provides 8 hours margin for extending such e-way bills before expiry of the e-way bill, where you can update the vehicle and revise distance details. So once the extension is done, then the entire risk of this liability, the detention, seizure, and penalty, then can be avoided. Also, in case of e-invoicing, a lot of companies where they are just crossing the threshold have confusion about whether e-way bill is really applicable to them. It's very important to at the start of each year for such entities to verify what the average annual turnover is, which is AATO, and then confirm whether e-invoice threshold has been crossed. If it has been crossed, to immediately implement the e-invoicing from the start of the next year itself. And this is the most irritable part of all GST compliances. I'm sure everyone attending this session has sometime or the other come across technical glitches, portal instabilities, where there is a portal downtime, where there is a payment gateway timeout, where tax amount has been debited in your bank account, but the return is not getting filed. It doesn't appear on the system. There are JSON upload failures where the return is prepared but cannot be submitted. There are e-sign and DSC failures. So the best thing to do in such cases is to file the returns well within time, never on the last day, because the portal congestion always is the highest on due dates. So it's best to file the returns as early as possible before the timeline. In case where there is a payment gateway timeout and the tax amount has been paid and it's not appearing in the GST system, it's best to check the bank statement if the debit has already happened. If it is debited, then it's best to communicate with the bank. We have seen cases where just by communicating with the bank, such situations have been resolved. And in case of any of such portal failures or technical glitches or instability, it's best to document all the failures with screenshots, timestamps, error codes, everything. Because if returns get delayed for any of the above reasons, there could be late fee that is applicable, but the late fee itself is a very minor implication. What is a major implication nowadays is the GST department and the GST officers have started sending notices under section 125, which is a general penalty for all such cases where there is no specific penalty mentioned anywhere in the act. And this penalty is a very high penalty. So for CGST 25,000, for SGST 25,000, and for IGST 50,000. So for every default, a 1 lakh penalty comes to the taxpayer. So where such penalty or late fee needs to be disputed, we need to have all the proofs in terms of screenshots, timestamps, error codes to prove that it was not our fault for the non-filing of the return or delayed filing of the return, but it was because of the technical glitches and the portal instability that the returns were not filed on time. Now, just to summarize, and in big books and records, it is important to maintain GSTN while GSTN level cost centers, maintain full records and give access to each GSTN, and most importantly, don't make any backdated entries. In case of ITC eligibility, it's best to track the ITC, claim the ITC before 30th November, which is the time limit under section 16.4, and claim and reverse the genuine unreconciled ITC items at the end of the year. In case of GSTR 2B, a monthly reconciliation is mandatory. It's best to always communicate with suppliers where there are differences and resolve those differences with such communication. In case of RCM, get confirmations from the GTAs, the transporters, for what system they have opted for, whether they have opted for RCM or forward charge, and accordingly take decisions on RCM. Make self invoices very importantly for every transaction where the supplier is an unregistered supplier, and pay all RCM only through the cash ledger, even in case of DRC03s. In case of place of supply, file the refunds in case of any wrong head that has been raised in the invoice. And also for any complex place of supply issues, it's best to get advance rulings or legal confirmations from firms like us to identify the right place of supply and charge the right tax. For ITC reversals, keep payment alerts in case of that 180-day reversals where you can reclaim the ITC after 180 days. Do a Rule 42 annual true up where you again rework the Rule 42 reversal for the entire year and either reverse the short reversal or claim the excess reversal. And maintain an asset-wise register in case of Rule 43 reversals. In IMS, it's best to integrate the IMS with the ERP or your accounting system, whereby uh, the invoices are marked with the accept reject pending remarks in the through the ERP itself. Review all the invoices by 15th and reduce the reliance on deemed acceptance. This could be very dangerous. In case of ISD, register as an ISD if not already registered. Do the distribution of common ITC on a monthly basis, and also distribute the ineligible ITC and make a reversal at the individual GSTINs. In case of e-invoicing and e-way bills, integrate the billing system for e-invoicing in your ERP or system itself, and build e-way bill into the logistics workflow itself, whereby if there is any difference in the e-way bill and the invoice, that gets identified there itself, and the transportation will not start unless a proper valid e-way bill is made available. For portal issues, it's best to file returns well before due dates. Always download the ARM for the returns filed and document every error and every portal glitch with screenshots so that any kind of disputes can be properly justified. So, all in all, proactive compliance is always cheaper than reactive litigation. So, build systems and not workarounds. Thank you very much. Subrata, over to you.
Thank you. Actually, it was actually a very meaningful presentation with lots of real practical experiences shared by you. I think we can now see the chat box for any questions that has come through. Um, Let me check. I don't see any now, till now. But guys, please ask your questions. Till the time people ask questions, Akshay, the last thing that you mentioned, that proactiveness is much important and very important than reactive measures and reactive litigation. I mean, we have seen a lot of these happening nowadays, wherein companies are may not be that proactive in dealing with such issues, and then after a year or two, then the reactive thing starts, and then there is litigation. So, GST compliance, guys, if you have seen the presentation, you've heard the presentation, what Akshay presented, you notice that there is, while it's working excellently, the portal is working fine, the returns are more or less now easy compared to what we had in 2017. Portal issues have come down, what we had during the service tax regime, not to talk about the VAT and excise regimes. But the fact is that within the system, now that the system is up and running, there can be issues, as Akshay pointed out. There can be um, issues which will affect and impact your balance sheet and P&L. Please don't let that happen, because uh, the issues, the more immediately and proactive manner that you address these issues, uh, the more better it is. And Akshay also mentioned about doing a diagnostic review. That's very important, to at least do a yearly review, a post-mortem of what your teams have done, so that you can identify any glitches, any errors that might have crept in. That's very important. Here we uh, questions, Akshay. You see
So,
questions
Gaurav,
coming up.
I can see one question which
Yep.
is about the review of unreconciled invoices, which was part of my third slide. So basically, what I mentioned was at the year end when we again reconcile all the invoices, and there are a lot of invoices which are genuine invoices where we have received the goods or services, where we have paid the supplier, where we have the invoice in our hands. But the supplier has not filed his GSTR1, because of which the invoice doesn't appear in the GSTR2B. And because of that, we are unable to claim the ITC. Now, beyond November of the next year, such ITC can become time barred. So, because of the supplier's fault, we become ineligible for claiming such ITC. Now, even if the supplier files his return, say beyond November, in December or in Jan, still we remain ineligible for claiming such ITC. So, to avoid such a situation, what I have said was claim the ITC in the return for October of the next year and reverse the ITC, because it is not an eligible ITC because the supplier has not filed his GSTR1. So reverse the ITC so that the original claim has happened within the timeline given by 16.4. The original claim has happened and you have reversed it also. Now the reclaim doesn't have any time limit. So when the supplier actually files his GSTR1 in say December or January, and now the ITC appears in the 2B, you can still make a reclaim. So because of no applicability of any time limit on the reclaim, the ITC still remains eligible for claim after the return is filed.
True.
Another question I can see is how to deal with bills of entries which are not appearing in GSTR2B. So as I mentioned, it's best to download all the bills of entries from the IceGate portal, uh, reconcile it with the bills of entries that are appearing in the GSTR2B. Even if there are certain entries which are available, which have been IGST on which has been paid, but which are not appearing in 2B, it is perfectly legal and perfectly valid to claim such bill of entries in case we have the proper documents and the proper bill of entries in hand. Such claim can be made in the GSTR 3B. Obviously, there will be a notice that will, because there will be a difference between the GSTR 2B and the GSTR 3B and the ITC claimed in the 3B. Then such notice can be easily answered through such proofs, and which is very easily accepted by the officers.
Akshay, there's another question which comes up very interesting, whether IMS will be made mandatory, compulsory.
It's, in my view, it's only a matter of time. uh, IMS definitely will become compulsory, but I think there are a lot of issues currently with the system. A few of those issues we also discussed, which need to be ironed out before the IMS is actually made compulsory. But in my view, sometime this year probably we can look at it being made mandatory.
Right. There is another question of how to distribute the ISD credit. Um, if you
So,
can
yeah, yeah,
throw
sure.
light
So the
on that.
ISD credit distribution is dependent on the turnover of the particular GSTINs. So, for example, if we have the head office is located in the state of Maharashtra, there are branch offices in Bangalore, in Hyderabad, in Delhi. So the amount of ITC to be distributed, common ITC, the thing to be remembered is the only ITC to be distributed is the common ITC, not the entire
Right.
ITC. So that common ITC needs to be divided into the head office itself and the Delhi, Hyderabad, and Bangalore branches. This distribution happens on the basis of turnover of those particular GSTINs of those particular states as a proportion to the total turnover for the entire company. So the basic formula is turnover of that state divided by the entire turnover of the company for that particular month multiplied by the common ITC. So that's the ITC that is to be distributed to the particular states.
And this has been made clear also that it rule will be to the formula based rule will apply on this one. So yeah.
And I would also like to tell all the participants that please feel free to mail your queries if the queries are not getting answered because of paucity of time. Please mail the queries to all the to any of us, to me, to Subrato. We'll be sharing the email IDs on the chat, and please feel free to post your queries on the email.
We can take two more questions, Akshay.
Sure.
Are there any coming on?
Yeah, this is an interesting question. Why, as a recipient, we are being penalized for suppliers' defaults when it comes to availment of ITC? If he has not paid the ITC, why recipient cannot avail ITC?
Right.
Uh, very important question, and I would like to say that most of the high courts, many of the high courts for that matter, have sided on the side of the taxpayer in this case. Uh, there have been cases where the high courts have specifically instructed the department to first approach the supplier, make the supplier pay, and only in case the GST cannot be recovered from the supplier, then come to the receiver and claim the GST from the receiver. Having said that, these situations will always go into litigation because there are specific provisions. The officers at the department level don't have any authority to go beyond what is mentioned in the law, and any such allowance has to then travel through the entire process of litigation. So it's best that we communicate with the supplier, get him to do his compliances, and then claim the ITC. Else, always the litigation is open for us. And always in litigation also there are possibilities of the case not being exactly similar to the cases that have been decided in the taxpayer's favor. So there is always a risk of the litigation going against us. So given all this, it's best to always communicate with the supplier and get the compliance done from the supplier.
Yeah, that's where documentation is very important, and we have been seeing very mixed rulings from the courts also on this matter. While little bit more weight is on the recipient getting credit and not to blame for supplier's default, but there are cases and rulings wherein it is the other way around. So it's has to be, what will save us is the documentation and the efforts that we made to get these things corrected. Yeah,
I think we are almost at the end of time. So if any queries have not been answered, request everyone to kindly post your queries on the emails, and we'll be
sure.
more than happy to answer the queries.
Right. So, what are the key takeaways? I've been listening to the presentation and the and the key takeaways that I've listed down. A few of them want to share with you. One is that books, records, your ERP system, your returns and supplier information must be aligned, must be in sync. That's very important. They must speak to each other. How they will speak to each other is for your team, for your departments, F&A departments to really work on that. That's very important. Number two, don't procrastinate, right? Don't procrastinate in taking corrective measures. That's very important. As Akshay rightly mentioned, ITC is something which is a cash. It's like a asset to you. Don't procrastinate in taking the right measures to see that you get the fullest utilization of the ITC, right? That's very important. The third one is ITC availment and utilization on one hand, and on the other hand, eligibility, ineligibility. These things are extremely important. If you have issues therein, please take advice and don't take ad hoc measures that, okay, we'll correct it next month. That next month will never happen, actually. Right? And we have seen more than enough cases wherein things were tracked at the end of the year while filing the October return after the end of the financial year, and then uh, doing that extra rectificatory effort to get things sorted, but then again ending up paying interest and things like that. So do the moment you realize there's an issue, and for that it's best to have your your GST filings reviewed at every quarter or every 6 months. That's very very important. At least, if not anything, then at least before the filing of your annual returns, definitely a postmortem needs to be done. And last but not the least, what I also was thinking, and as Akshay was saying, as making his presentation, is that be updated. That's extremely important. Be updated on the provisions, be updated on the rulings, whatever is coming up. We also circulate the GST updates every week. Please be updated, because if you are not, then I can only say we are losing the bus, because compliance is something, if not done in time and if not done properly, will have effect where it can hit back and boomerang onto you. I think with these words, Akshay, will close the webinar today. Thank you for patiently hearing us out, coming to attend this webinar. And if you have any queries, please feel free to connect with us. Thank you very much.
Thank you, everyone.